The 1920s are back. Here's how it affects your portfolio. As tactical portfolio investors, learning from history and following the business cycle are paramount. While every cycle is the same, except for what is different, the current U.S. economic and stock market environments share many similarities with the 1920s environment. These include similarities like robust growth, industry rotation, and a K economy. A K economy is described as a stark difference in prosperity for different segments of the population. This is very evident today in looking at the contrast of high auto and credit card delinquencies, paired with wage stagnation versus high leisure spending and stock market valuations. In order to show this, let's start by taking a trip to the 1920s. Ah yes, the 1920s, when booze was illegal, The Great Gatsby was written, and the Great War had just ended. The 1920s was a time of massive industrialization in the United States. Along with this massive economic growth came a booming stock market and real estate market. The stock market soared, and those that could afford it bought stock and used margin to increase their exposure. These were the individuals that made up the top part of the K. On the other hand, older industries like textiles, coal, railroads, and most importantly, farming, which employed close to 30% of the workforce, saw huge wage decreases. It is important to note that some industries, such as manufacturing, saw modest wage gains. Some historians argue that due to variables like wage growth in manufacturing, the 1920s does not represent a textbook K economy. I would argue that the industries with wage decreases made up a large enough percentage of the workforce to refute this claim. The country as a whole was growing rapidly, but the industries that had been the cornerstone of American employment were shrinking. These are the Americans that made up the bottom of the K. On the other hand, those with cash on hand and a line at the bank could not get enough of the stock market. The cab driver, the shoeshine boys, everyone who could was buying. That was until October of 1929, when the music stopped. And when the music stops in a highly leveraged and highly speculative market, the risk that can be realized is ginormous. As the market fell, margin calls flooded the market. Momentum feeds on momentum. Over a 3-year period, from its peak in September of 1929 to its bottom in July of 1932, the Dow Jones fell 89%. And as Warren Buffett put it, only when the tide goes out do you discover who's been swimming naked. Back to the present day, we don't foresee a 1920s style stock market crash. This period does, however, give you perspective of the level of risk that exists in today's asset prices. Just like in the 1920s, the 2010s and the early 2020s have been a time of low interest rates, excessive leverage, and speculative investors. And once again, a portion of the citizens are doing very well, especially as their assets continue to grow, while another group sees little wage growth, a tightening job market, and huge increases in the cost of living. While wages stagnate, those with assets rely on their paper wealth to pay for leisure and living. But what happens when an already weakening economy faces an asset price decrease? When people feel poor, they don't spend money. The overexuberance of the 1920s was magnified both on the upside and downside by human behavior. If you think human behavior is much different today than it was back then, I suspect you've got another thing coming. Recently, stocks like GameStop and funds like ARKK are easy to point to. These securities had huge gains that rallied everyone from Wall Street bulls to first-time investors. But one must also look under the hood of today's market. Growth stocks, leveraged funds, the Magnificent Seven, and private placements. All of these are at historically high valuations, but almost no one seems to care. Buy the dip is what they say. It only goes up, they say. While it is nearly impossible to predict when a stock market crash will happen, it is possible to estimate the potential risk versus return in the market. There are times, especially at the beginning of a business cycle reset, where risk tends to be low and return potential may be high. And right now, there is a lot of risk. Perhaps the One Big Beautiful Bill Act creates enough stimulus to get the U.S. through the end of this business cycle. Maybe not.